Hi, welcome to our Q1 2026 market review. I won't sugarcoat it. The first quarter was challenging, with most equity markets posting negative returns. But over the next few minutes, we're going to look beyond the short-term noise and examine what really matters most, how your long-term returns remain strong, why one difficult quarter doesn't derail your financial plan, and most importantly, why staying invested during periods like this is exactly what separates successful investors from everyone else. Let's dive in.
Let's talk about what happened in the first quarter of 2026. And I'll be honest, it wasn't the start to the year anyone hoped for. US stocks declined 3.96%, international developed markets fell 0.94%, and emerging markets dipped 0.17%. The only bright spot in equities was global real estate, which managed to edge up 0.77%. On the bond side, we saw small losses as well, with US bonds down 5 basis points and global bonds declining 19 basis points. Now, before we let one difficult quarter shake our confidence, I want you to look at the bottom section of this slide. Since January 2000, the average quarterly return for US stocks has been 2.3%. But notice those worst quarters. 2008 saw a 22.8% decline in US stocks. 2020 saw a 23.3% drop in international markets. This quarter's losses, while unwelcome, are nowhere near those extremes. Here's what this tells us. Down quarters are a normal part of investing. They're not failures. They're the price of admission for capturing those long-term gains we're about to discuss. And when we look at the historical data, Q1 of 2026's performance is well within the range of typical market behavior. This is the slide that puts everything in perspective, and it's why we don't make investment decisions based on one quarter. Despite that challenging start to 2026, look at what's happened over the trailing 12 months. US stocks are still up 18.09%, international developed markets gained 22.99%, and emerging markets delivered an impressive 29.55% return. Even with Q1's decline, investors who stayed invested captured extraordinary one-year returns. But here's where it gets even more powerful. Look down this page at the 5, 10, 15, and 20-year numbers. Every single asset class, stocks and bonds, domestic and international, shows positive returns across all these time frames. US stocks have delivered 10.26% annually over 20 years. That includes the 2008 financial crisis, the 2020 pandemic sell-off, and yes, it includes quarters like Q1 2026. This is evidence that long-term investing works. The investors who panicked and sold during bad quarters over the past 2 decades missed out on these compounding returns. The ones who stayed invested, who understood that volatility is temporary, but time in the market is permanent, the likelihood is higher for them to capture these numbers. This final chart tells the real story of the past year, and I think it beautifully illustrates why we invest the way we do. You may remember it from last quarter's commentary. It's been updated for Q1 2026, and I wanted to revisit it. That upper right chart shows the long-term perspective from 2000 to 2026. Through multiple crises, the trend is unmistakably upward. Yes, there are dips, but the trajectory is clear. Now look at the short-term chart covering Q2 2025 through Q1 2026. You can see that recent pullback in the first quarter, but look at all the headlines that came with it. Tensions over Greenland, tariff uncertainty, Federal Reserve rate decisions, geopolitical conflicts, and concerns about government spending. In the moment, each of these felt significant, maybe even crisis level. But here's my point. 12 months ago, we had different headlines creating different concerns, and investors still captured those 18 to 29% returns we just discussed. 12 months from now, there will be new headlines creating new worries. The headlines change, but the principle remains the same. Market volatility isn't a bug in the system, it's a feature. It's what creates the opportunity for long-term returns. Investors who stay disciplined through quarters like Q1 2026 are the ones positioned to capture the recovery and growth that historically follows. Your portfolio is built for this exact scenario, not to avoid volatility, but to weather it and come out stronger on the other side.
Here's the bottom line. Q1 was a tough quarter, but it doesn't change the fundamental truth that long-term investing works. Despite this quarter's decline, trailing 12-month returns remain exceptional, and every long-term time frame we examined shows positive results. Markets will always test our patience, but your financial success depends on staying the course through both the ups and the downs. Thank you for your continued trust, and as always, if you have questions about your portfolio, we're here to help.